Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Thanks for joining us here at AusBiz. Let's get across those market moves overnight. Global investor sentiment improving as oil prices fell sharply. That after US President Donald Trump declared the Middle East war could be over soon, despite the US and Israel intensifying their strikes on Iran. Well, the optimism about an end to the war initially boosted stocks on Wall Street before momentum was lost on renewed military threats and concerns of economic stagflation. Well, stocks specifically chip makers were high. Nvidia, SanDisk and Western Digital posting solid gains. Enterprise software maker Oracle posted quarterly cloud revenue that was better than expected and projected strong sales in the upcoming fiscal year as it consolidates its AI booking shares surging around 8% in after-hours trade. Health insurer Centene plunged after it reaffirmed its 2026 profit forecast. Department store chain Coles signalled improvement in its apparel category in the first quarter, even as it warned of another year of declining sales overall. Boeing said a wiring flaw found in its 737 MAX will delay some delivery of its narrow-body jet, which sent its shares lower. The US plane maker saying its overall delivery target of roughly 500 of the 737 jets this year remains unchanged. And Europe's largest car maker Volkswagen expecting another tough year, dominated by tariffs and competition with China, after it reported a slump in operating profit and forecast only a modest margin recovery. Well, the United States and Israel have continued to bomb targets in a day described by both the Pentagon and Iranians as the most intense airstrikes of the war so far. Iran's Revolutionary Guards have said they would block oil shipments from the Gulf unless the US and Israel cease their attacks. CBS News and CNN both reporting that Iran has begun laying mines in the Strait of Hormuz. While President Trump has said that 10 mine-laying boats had been destroyed by US forces, and he threatened Iran if they are planting explosives in the channel, posting on social media that if Iran has put out any mines in the Hormuz Strait, we have no reports of them doing so, we want them removed immediately. US Treasury yields were mixed, with the 2-year rising at 3.59, the 10-year was at 4.15. Australian 3-year government bond yields were close to 4.5%, the 10-year at 4.9. Markets pricing in a 65% chance the RBA cash rate will be hiked by 25 basis points at next week's meeting. This as RBA Deputy Governor Andrew Houser said further inflationary pressure from Iran and the war there would be unhelpful, saying we've had some data that seem to have confirmed even more decisively than we had before that our economy currently has limited spare capacity. It's fair to say further increases of prices from the Iranian war, if that is what we end up seeing, that's big, if not a helpful development from the perspective of our policy discussion. Well, the US dollar index was down around 1/3% on the day. The Aussie has strengthened to 71.1 US cents. Oil prices plunged by more than 11% overnight. That's the steepest percentage drop in 4 years. Brent crude futures falling from $95 to $81 a barrel, but are currently back around $91 a barrel. Gold has been buoyed by a softer US dollar and easing inflation concerns. Spot gold currently close to $5,200 an ounce. Copper was up 1.5%. Iron ore at 106 US a ton, and Bitcoin is back above 70,000, or just below 70,000 US dollars. Well, let's get a global view from an Australian perspective. Elfreda Jonker from Alphinity Investment Management talks about the need to have a balanced approach in turbulent times.
The US-Iran conflict is really a huge repricing and a huge a very volatile market with huge repricing in the oil price, up and then again down, and the spillover effects into what that means for growth or inflation, interest rates and so forth. So I think bottom line is there are many ways to play a situation like this. You can see it as a buying opportunity for something that you really wanted to have, that you think is oversold, or you can bunker down and really just stick as close as possible to your investment process, because that is really the ultimate crux, is don't change your investment philosophy and process during times when it is difficult.
So you don't think you necessarily need to take a more defensive stance then?
Yes, I think over the last few months we have been increasing some of our more defensive exposure on a relative basis. Firstly, cyclicals have massively outperformed defensives, but we have consistently held some defensive exposure. So if I talk about defensive, I mean companies like staples, for example. We've got Costco, Coca Cola, Walmart, these sort of companies that will give you that consistency when the market is quite volatile. I think as far as if you take it a step further and you just link it to the defense side of this whole situation we're in, it's very clear that globally governments are definitely increasing their defense spend. If you just look at NATO, their new target is around 5% of GDP. So you know there's a huge amount of money that's going to flow through defense budgets and into the whole defense ecosystem. And I think for us, if you just take a step back, the point we want to make is that you don't necessarily have to have a defense manufacturer like a BAE. You also actually get a lot of exposure through the rest of that ecosystem to that kind of a narrative. And
what sort of names are you looking at then?
Yeah, so there, what I mean is if you look at the whole defense supply chain, first off, you have companies like Motorola Solutions, for example, that is sort of give that first defense communication system. So they really benefit from increased spend on communication systems. You've got companies like ABB, for example, Parker-Hannifin. Specifically, what they do is basically industrial automation, which is very important for defense spend. Caterpillar, that gives, that manufacture the large defense type equipment you can use. So there's just a long range. And I think what is important from a portfolio construction perspective is to understand how each of these narratives are impacting your portfolio and which stocks, even though it's not very obvious, will move on the back of these sort of trends. And you can say the same thing about the AI trend, for example.
Well, speaking of the AI trends, the market has moved on, at least for now, hasn't it, because of what's going on in the Middle East.
Yes.
Yet, what are we seeing there at the moment? How do you see that AI play, the disruption, the SaaS apocalypse? I mean, is that still of concern for investors?
I think it will continue to be a bit of a question mark, and the reason for that is what is the valuation of these sort of large software companies in the future going to be worth? Because in the long end, you might not get that sort of growth that you previously expected that you will. I think for us, one of our portfolio managers and one of our analysts just recently visited the TMT conference in San Francisco, where every single company that's got anything to do with technology would present. And one of the key things that came out of that is that specifically for certain software names, like a ServiceNow, for example, that we own, that is not necessarily dead. They have gone through great lengths to describe that they will not be replaced by AI, but they're also incorporating AI to deliver better service going forward. So yes, there's a lot of sort of uncertainty and a lot of sort of big question marks around which of these sectors are being impacted or not. We think a lot of that fear is probably overdone, similar to the reaction to the Iran war. A lot of that sort of initial reaction is probably overdone.
So out of that conference and the presentations, which one are you liking there at Alphinity?
So we currently still have exposure to Microsoft, which is obviously a Mag 7, but also a big software business. And ServiceNow is probably the other one. I think the point that we will make on a Microsoft, for example, given the big pullback that we've seen in the Mag 7 and that sort of median PE now trading at 22 times relative to the overall S&P market that's trading at around 18, 19, there's a lot of buying opportunities that's now opening up there in the Mag 7, but you need to be selective. And that's where Microsoft for us is a very integrated business. They are rolling out AI across the board. And then the other thing that really came out of that conference is just a massive demand for cloud operators. And that is where obviously where Microsoft is still offering that. So a better entry point here if you don't own Microsoft.
All right, Microsoft being one of the Mag 7, looking at that group, has derated. Are you seeing opportunities there as a result?
Yes, I think what we have been doing over the last sort of few months is to expand our AI exposure, AI infrastructure exposure, sort of beyond the Mag 7s again. What this sort of recent sell-off has done is definitely to create opportunity, if you've missed that, to top up. For example, NVIDIA, once again, super strong presentation, outlook, result. That company is growing, at sort of 60%, and it's trading at a much lower multiple than someone like a Walmart, for example. So we do think there are selectively opportunities to add to the Max 7. Particularly, I think for us, Microsoft, as I mentioned, is still the standout, but we continue to like sort of Alphabet as well as really anything AI at the front end of that. But also, I would say Meta, given the recent result, given their spending, we think that outlook for advertising and the revenues they can generate will be enough to offset a lot of the skepticism around them. So there is a place for the Max 7 in your portfolio, and there's also space for additional AI infrastructure positions still in your portfolio as well at this point in the cycle, according to us.
And have you added any new names to your portfolio recently?
Yeah, so one interesting name that we've added that's probably just a little bit away from defense and AI is a company called Welltower. They are really sitting at that sort of intersection of health, real estate, and the aging population. So effectively what they do is they have real estate focusing specifically on that elderly cohort that offers not just normal sort of housing, but also that assistance, medical assistance housing. And what they've seen over the last while, firstly, real estate has really been under a lot of pressure, but what they also have is a new system that they've rolled out. They've actually spent a lot of time and money on LLMs or large language models in real estate, and they are now at the point where they will be rolling out that product of theirs called Citadel, which will be an additional revenue stream for them over and above what they're already earning. So there's a few tailwinds for a company like that that we continue to find in the market that's a bit beyond those sort of bigger trends and just allows for more diversification and a more balanced approach in your portfolio.
That's Elfreda Jonker from Alphinity Investment Management. So let's turn our attention to the local market as we get just about to get underway here for the open, excuse me, and looking to build on those gains we had yesterday. So trying to claw back those dramatic falls we saw on Monday. S&P ASX futures there up close to 0.3%. Not a lot of market moves to go on today, just in terms of news, I should say. Little data and not a lot of corporate news either, but clearly a focus will remain on that oil price and where that tracks. Stay with us. The Open is up next.